Testing one, two, three, go. Welcome back to Chapter 6, Merchandise Inventory. This is part two. This is part two of Chapter 6, Merchandise Inventory. So in this video, we will begin with learning objective 6.3. Compare the effects on the financial statements when using the different inventory costing methods. How are financial statements affected by using different inventory costing methods? What leads Smart Touch Learning to select the specific identification, the FIFO, LIFO, or weighted average inventory costing method? How do they make that determination? Why do they make that determination? The different methods have different benefits. Many companies prefer high income in order to attract investors and borrow on favorable terms. FIFO, it offers this benefit in a period of rising costs. Lower profits means lower taxable income. So LIFO lets companies pay the lowest income taxes when inventory costs are rising. Therefore, companies that seek a middle ground solution, they would use the weighted average method for inventory. Here you see in Exhibit 6.7. It summarizes the results for the 4 inventory costing method for Smart Touch Learning. It shows revenue, cost of goods sold, and gross profit for specific identification, FIFO, LIFO, and weighted average. First, we see FIFO produces a lower cost of goods sold and a higher gross profit than either LIFO or weighted average. Also, see that LIFO, it provides a higher cost of goods sold and a lower gross profit than FIFO or weighted average. Again, you see that LIFO provides a higher cost of goods sold and a lower gross profit than FIFO or weighted average. Weighted average provides a cost of goods sold and a gross profit that is between LIFO and FIFO. Here, Exhibit 6-8, it shows the results of Smart Touch Learning's ending merchandise inventory for each of the costing methods for the month of August. Notice that when using FIFO inventory costing method, the ending merchandise inventory will be the highest when costs are rising. LIFO produces the lowest ending merchandise inventory, and weighted average is again in the middle. The weighted average ending merchandise inventory number shown here or shown back on Exhibit 6.6 may be slightly different than that found here in Exhibit 6.8. Now this is because of rounding. When completing your homework, always read carefully for directions on how to round when using the weighted average method. Again, when completing your homework, always read carefully for directions on how to round when you're using the weighted average method. Exhibit 6-9 summarizes the effects on the financial statements during periods of rising and declining inventory costs. The relationship that we observe with our inventory example will be true anytime that costs are constantly increasing. When prices are constantly decreasing, the relationship will be just the opposite. Okay, here we are learning objective 6.4. Apply the law of cost or market rule to merchandise inventory. Even after we have used one of the inventory methods to determine the cost of the ending inventory and the cost of goods sold, there is a limiting rule in accounting called the law of cost or market or the LCM rule. Now, under the LCM rule, the final carrying amount of the inventory on the books will be the law of the cost as determined using one of our inventory methods or the market value of the inventory. In some cases, inventory will decrease permanently in value when it's being held by the company. For example, a new product may be introduced by a competitor that makes all existing inventories obsolete. In such cases, the market value of the inventory on hand may actually be lower than its original cost. In those cases, we will adjust the inventory to the lower amount. Let's assume that Smart Touch Learning paid $3,000 for inventory. By December 31st, that inventory is worth only $2,200, and the declined value appears permanent. We will adjust the $3,000 debit balance in inventory by crediting it for $800, bringing that balance to $2,200. The debit for the adjustment will be to the cost of goods sold. So that difference, that $800, there will be a debit to cost of goods sold and a credit to merchandise inventory. That's the $3,000 minus the $2,200. Now, companies often disclose information about their merchandise inventory in the notes to their financial statements. Often, this includes how merchandise inventories are valued. And here you see in this example, on this slide, there's a disclosure. Statement of significant accounting policies. Here we begin with learning objective 6.5. Measure the effects of merchandise inventory errors on the financial statements. Measure the effects of merchandise inventory errors on the financial statements. So what are the effects of merchandise inventory errors on the financial statements? It is crucial that the ending inventory amount on the balance sheet is correct. If it is incorrect, it will have a domino effect on several other numbers, such as the cost of goods sold, the gross profit, and net income. To illustrate an inventory error, assume Smart Touch Learning accidentally reported $5,000 more ending merchandise inventory than it actually had. In that case, ending merchandise inventory would be overstated by $5,000 on the balance sheet. As such, cost of goods sold is understated, and gross profit and net income are both overstated. Understating the ending inventory or reporting the inventory too low has the opposite effect of an overstatement. If Smart Touch Learning's inventory is understated by $1,200, the cost of goods sold would be overstated, the gross profit and net income would be understated. Recall that one period's ending merchandise inventory becomes the next period's beginning inventory. As a result, an error in ending merchandise inventory carries over into the next period. Here you see in Exhibit 6-10, it illustrates the effect of an inventory error. Assuming all other items on the income statement are unchanged for the three periods, you see here period 1, the ending merchandise inventory is overstated by $5,000. Period 1's ending merchandise inventory should be $10,000. So the error is carried over to period 2. Period 3 is correct. In fact, both period 1 and period 2 should look like period 3. Ending merchandise inventory is subtracted to compute cost of goods sold in one period, and the same amount is added as beginning merchandise inventory in the next period. Therefore, an inventory error cancels out after two periods. The overstatement of cost of goods sold in period 2 counterbalances the understatement for period 1. Thus, the total gross profit for the two periods combined is correct. Here you see the effects of the inventory errors summarized in this exhibit 6-11. The effects of inventory errors. Here we begin with learning objective 6.6. Use inventory turnover and days sales in inventory to evaluate business performance. Companies trying to manage their inventory levels such that they have just enough inventory to meet customer demand without investing large amounts of money in inventory sitting on the shelves gathering dust. The inventory turnover ratio measures the number of times a company sells its average level of merchandise inventory during a period. And that is inventory turnover is equal to the cost of goods sold divided by the average merchandise inventory. A high rate of turnover, it indicates ease in selling inventory, which is a low rate will indicate difficulty. A low turnover rate indicates difficulty of selling. The days sales in inventory measures the average number of days that inventory is held by a company. Days sale in inventory is equal to 365 days divided by inventory turnover. A lower days sales in inventory is preferable because it indicates the company is able to sell its inventory quickly, thereby reducing its inventory storage and insurance costs, as well as reducing the risk of holding obsolete inventory. Note that some types of inventory will move faster than others, and for inventory with an expiration date, this measure is very important. Let's return to Kohl's Corporation and evaluate the company's inventory levels using the two ratios we discussed. Kohl sells its average inventory at 3.48 times per year. A high turnover rate is desirable, and an increase in the turnover rate usually means higher profits. Kohl's days sale in inventory of Kohl's indicates that the company, on average, takes 105 days to sell inventory. Now, this seems a little high for a retail store, but it should be evaluated against the industry average. Learning Objective 6.67. Learning Objective 6.7. Account for merchandise inventory costs under a periodic inventory system. Learning Objective 6.7. How are merchandise inventory costs determined under a periodic inventory system? An alternative to accounting for inventory using a perpetual approach is to account for the inventory using a periodic approach. Under the periodic approach, the tedious task of recording each sale as it impacts cost of goods sold and the inventory account is eliminated. Essentially, we will start the month with a balance in beginning inventory. As we acquire additional inventory, we record that inventory in a purchases account. When we sell inventory, we do not record an adjustment to the inventory or cost of goods sold account. Rather, we only record the sale and its impact on cash or accounts receivable. Remember, under a periodic inventory system, inventory is not tracked in the accounting system continuously. The beginning inventory balance is carried until the end of the period. Purchases are accumulated during the period. The ending inventory balance replaces the beginning inventory balance. To show how the periodic inventory system works, we use the same Smart Touch learning data that we use for the perpetual inventory system back in Exhibit 6A. Um, 6A. But here in this Exhibit 6A-1, we'll see how we use the perpetual inventory method. We will start with the information in the accounting records regarding the flow of inventory during the period. We can see from the inventory record that we start the month with 2 units. 2 units in inventory. We purchased more inventory on August 5th, 4 units, and on August 26th, we purchased 12 units, for a total of 16 units purchased during the month. Combined with the beginning inventory of 2 units, there are 18 units available for sale during the month. We sold inventory on August 15th, 4 units, and on August 31st, we sold another 10 units, for a total of 14 units sold during the month. So here you sold a total of 14 for the month. You purchased 16 for the month, but you had 2 on hand. That's how you got the 18. Cost of goods available for sale is always the sum of beginning inventory and net cost of inventory purchase, which totals $6,700 in this example. The different methods, specific identification, FIFO, LIFO, and weighted average cost, compute different amounts for ending inventory and cost of goods sold. In other words, the $6,700 invested in cost of goods available for sale will either be will, will be either on the balance sheet in merchandise inventory or expense on the income statement as cost of goods sold. The amount on the balance sheet will be the assumed cost of the four tablets that were not sold and are still on hand. The amount on the income statement will be the assumed cost of the 14 tablets sold. Under the FIFO method, the cost of goods sold is based on the oldest purchases. That is, the first units purchased are assumed to be the first unit sold. The ending inventory comes from the newest, the most recent purchases. During August, Smart Touch Learning sold 14 units. This leaves 4 units in the ending inventory. That's the 18 units available for sale less 14 units sold. The ending inventory will be made up of the newest, most recent purchases on August 26th, which cost $380 per unit. The cost of goods sold is made up of the beginning inventory. That's the 2 units at $350, and the earliest cost, 4 units at $360, and 8 units at $380. Notice that the FIFO periodic cost of goods sold is $5,180, exactly the same amount as we calculated using the FIFO perpetual inventory method. The amounts obtained for cost of goods sold and ending merchandise inventory are always the same for FIFO perpetual and FIFO periodic. Now, this occurs because FIFO sells the oldest inventory acquisitions first. Therefore, it does not matter when FIFO is calculated. The earliest purchase will always be the same whether we calculate cost of goods sold on the sale date, which is the perpetual, or at the end of the period, the periodic. Under the LIFO method, the cost of goods sold is based on the most recent purchases or the newest costs. That is, the last units purchased are assumed to be the first units sold. Ending inventory comes from the oldest cost of the period. In this case, the beginning inventory of 2 units that cost $350 per unit, plus 2 from the first purchase on August 5th at $360. The cost of goods sold is made up of the most recent purchases. That's the 12 units at 380 and 2 units at 360. Notice that when using the periodic system with the LIFO method, the dollar amounts obtained for the ending merchandise inventory and cost of goods sold are different. They are different than those obtained with the perpetual inventory system. This is because the perpetual inventory system keeps a running balance of inventory while the periodic inventory system does not. Under the periodic inventory system, the ending merchandise inventory is determined without regard to when the sales dates of inventory occurred. Again, under the periodic inventory system, the ending merchandise inventory is determined without regard to when the sales dates of inventory occurred. With the periodic weighted average method, the order of the sale is irrelevant. All inventory, all inventory will be removed from the inventory using the average cost of the inventory for the period. The first step is to determine the weighted average cost per unit of the inventory. Then the single weighted average cost per unit will be applied to compute ending merchandise inventory and cost of goods sold. As was true of the LIFO periodic method, weighted average periodic method results in different dollar amounts for the ending merchandise inventory and cost of goods sold than those obtained with the perpetual inventory system. Again, this is because the perpetual inventory system keeps a running balance of inventory, while the periodic inventory system does not. Under the periodic inventory system, the ending merchandise inventory is determined without regard to when the sales dates of inventory occurred. And this is the end of chapter 6. This is the end of part 2 of chapter 6, which also concludes chapter 6.